Investors always underestimate exactly how close the next stock market crash actually is. It can wipe out years of gains in just a matter of days or weeks. And in this video, you're going to hear expert opinions that nobody's talking about. If you stay till the end, I'm going to show you exactly how I'm hedging my portfolio with a live trade on the trading platform. Before we dive in, go ahead and smash that like button down below. It really helps out the channel and I appreciate it very much. You're certainly welcome to subscribe as well. We're at an all-time high for subscribers, so thank you very much. And download the free options workshop in the link as well. And there's a paid course if you're new to option trading or if you just want to level up your game. It's on sale right now. Right now, the stock market's showing clear signs of being overvalued. Forward price to earnings ratios are around 23, levels seen only about 7% of the time in the past 40 years, signaling expensive valuations. The cyclically adjusted price to earnings ratio, the Shiller Cape, is near 38, well above historical averages, indicating risky market conditions. Additionally, the Buffett indicator, which compares total market value to GDP, stands at 217%. So it's about 2.2 standard deviations above the long-term trend, pointing to strong overvaluations. This valuation premium comes amid persistent inflation concerns and uncertain Federal Reserve policies, which add to market fragility. Inflation remains elevated, influencing forward earnings estimates downward, while the Fed's moves on interest rates continue to inject volatility. Together, these factors flash warning signals that the market may be susceptible to a significant downturn in the near future. Experts point to several key triggers that could ignite a stock market crash. One major risk is unexpected policy shifts at the Federal Reserve, either delaying interest rate cuts too long or cutting too soon, both scenarios risking market volatility and impairing investor confidence. The next meeting is September 17th, so it's coming up soon, and right now there's an 85% chance of a quarter-point cut, so that's priced in right now. Global recession fears also loom large amid slowing economic growth and rising corporate debt. Geopolitical conflicts and ongoing trade tensions with new tariffs exacerbate uncertainty and disrupt supply chains, further unsettling markets. Rising oil prices could add inflationary pressure and increase costs for businesses and consumers alike. Lastly, shifts in investor sentiment, especially prompted by faltering leadership in tech or the AI sectors, may cause rapid sell-offs that escalate market corrections. Together, these catalysts could quickly amplify volatility and fuel a sharp market downturn if multiple risks materialize simultaneously. September has long carried a historical reputation for the worst month in the stock market. Now, historically, the S&P 500 has declined in September about 56% of the time, with an average loss near 0.8%, going back nearly a century. This makes the only month with a consistently negative average return, earning it the nickname the worst month of stocks. Notable steep declines have occurred in September tied to major crises, including the Great Depression of 1931 and the historical turmoil of 2008. Despite the gloomy history, September is not always disastrous. Over the past 98 years, the month has still been positive about half the time, and some years have seen strong rebounds following September dips. Many analysts attribute these seasonal pullbacks to factors like portfolio rebalancing, tax loss selling, and decreased retail participation after summer. Understanding this pattern can help investors prepare for temporary volatility rather than long-term losses. To protect your investments and portfolio during these looming stock market crashes, experts universally recommend avoiding panic selling and staying committed to a long-term plan. Diversifying portfolios across different asset classes, so stocks, bonds, gold, and defensive sectors like utilities and consumers, can reduce risk and dampen volatility. I'm not so sure about bonds right now. Safe haven assets such as gold and short-term government bonds, often serve as cushions during sharp downturns. Risk management is equally important. Setting clear stop loss levels, adjusting position sizes based on market conditions, and considering portfolio hedging strategies like buying put options on key indices can help limit losses. That's what I'm going to talk about right here. So let's jump into it. I'm going to show you exactly what I'm doing as a hedge in my portfolio right now.
Woo! Look at this down market today, guys. The SPY is down 0.68% today. So what I'm going to do is I'm going to put on a hedge. I'm going to buy a put in the SPY, and I'm going to show you how I'm doing it. So I'm going to go to the trade page. We're on the Tasty Trade option trading platform. This is my favorite. Super intuitive, and there's a link down below. There's some benefits if you go through my link, so check it out. All right, so we're going to go to the trade page. Actually, look really quick at the where we are in the market. This is the 1 year chart, and we're at the top of the Bollinger Band, and we're way up at 652. And over the long term, we're up quite a bit as well. If we look, out 10 years, we're still way up there. So what I'm going to do is go to table mode here, and we're going to go to the regular option chains. I don't like trading the weeklies, just there's more volume in the regulars. And I'm going to go out 84 days. And the reason 84 days, because I'm going to get rid of this, I'm going to get out of this in 60 days. Because in the last 60 days, really the last 30 days, as you get closer to expiration, the time value really eats up the price of the stock, so of the stock option. And as you know, one stock option controls 100 shares of stock. So let's go to the 84 days, November. Let's open that up. And we're going to go, puts are on the right, calls are on the left. We're going to buy a put. I'm going to buy the 640 right here. Buy is on the right. Here's sell. We're going to buy that for $13.98. So that's really $1,398. So mid price is right here. Now take a look. If we go to the expiration, if we go out a little bit further, 112, we're at 1662. So that's why I like, so it's 250 bucks more versus 84 days. And if we go in to 49, that's kind of too close, and it's 10 bucks, so you don't save that much. That's why I like that 13.98 price for 84 days, and I can get out of this, in 30 days or so. If there's a big drop, I'm protected during that period of time. So look at this. The max profit, $62,604. Now that's if the SPY goes to zero. That's not going to happen. But what it does for this $1,394, if we go to curve mode here, this is what I really like about Tasty Trade and analysis. You can see as the stock market dips, we make money continuously. So if it gets down to 600, we make $2,574 at expiration. If it gets down to 610, we make 1,600. So if it gets down to 615, actually, where's our stock double? 1,400 is right around this 612 level. And if you look at that, there could easily be a pullback to this range down here after this run up. So that's why I like this trade. So I'm putting this on. I'm going to just go ahead and put it on right here, and we'll review and send and place that trade, and we've got it filled at 1423. Now if I'm wrong and the stock market goes up, then you know what, all these other positions that are down today, but we're doing well year to date, but if this goes down, my hedge, I'm fine with it, because we're going to have that gain right here. So as the market drops, we're going to hedge, and we're going to collect, or we're going to that stock price, the option price, is going to increase in value, and we'll be able to sell it on that dip. If we lose and we go up here, our max loss is that the 1422 that we paid up front for the protection, and we lose the 1422, but you know what happens at the same time? All my other positions make money, and they'll easily make up that 1422 moving forward. So that's my hedge.
All right, guys, leave a comment down below. Let me know exactly how you're hedging your portfolio. Remember to like and subscribe. Download the free options workshop in the link below. Check out the paid course if you're new or learning options, and if you want to level up your game, it's on sale right now. And watch this next video. See you in the next one.